In this video, we're going to review my top 8 home buying tips. So before we begin, we want to think of what is going to be the budget for the property. And you want to make sure your finances are in order before even considering looking at properties. This means on Zillow, this means on Realtor.com, this means on Redfin. You want to make sure you have the savings. This could take anywhere from 6, 12, 18, 24 months. And I recommend, I said this in a previous video, ideally you want anywhere from 7 to 12% saved of the purchase price of the property. In my theoretical $300,000 property, that's going to be in the ballpark somewhere from 20 to 25,000 if you plan on using a down payment such as FHA, which is 3.5%, or conventional, which is 3%. Make sure you have your finances in order before start looking at properties. It's smart to educate yourself before getting started there. Next is a lender is going to look at the income, and they're going to want 2 years of steady income. I know when I recently, actually not recently, when I got pre-approved for my property, this was a couple years ago, they wanted 2 years of my income, and that was something I knew before buying. So if you're just graduating or you're about to graduate college, they may waive it somewhat, depends on the lender, but ideally they want 2 years of a working history to show if you're a 1099 self-employed or if you're a W-2 job, 2 years of income. They're going to use your most recent 2 years of income to qualify you for the loan. And if you don't have any rental properties or anything like that, they're going to use these 2 years, and that's going to match your income, which we're going to talk about later, which is important for your debt to income ratio when you are looking to buy. A strong credit score will be super helpful in this. This just shows when you do take out money, and that's why I recommend have a credit card when you turn 18, or have a credit card and pay it off like a debit card every month, just because it shows you borrow back the money you pay. I've been doing this for a while, and the card I use is 1% cash back. Building strong credit is critical just because the stronger the credit score, the better loan you're going to be getting, and not just the better loan, I'm talking about the better points you're going to be getting on the loan. For example, if the rate is around 3% and you have a higher credit score, it's likely you might get 2.9 or 2.85 rate instead of a higher rate on the interest because your credit is higher. The debt to income ratio, this one here, is your income you have on a monthly basis. You want that obviously as high as it can be. And if it's a W-2 job, it's going to be that, the income divided by 12. That's your monthly income that they're going to be using divided by your debt. So this can be student loan debt, this can be car debt, this can be credit card debt. For the big three, you want your debt to be as small as possible, income to be high as possible in order to qualify for the property. But if you know it prior, it's just super helpful. One thing that I have done that I would recommend if you're looking to really save money and invest at a pretty good rate is to always buy cars used in full. The reason behind this is you're not having a depreciating asset that you're paying every month, and it goes down value essentially when you drive it off the lot. I've driven cars that are not in super great shape, that are relatively cheap on a budget perspective than having a very nice car and having a car payment. And that's my own choice in order to kind of save money and start investing, in my early 20s doing that. Although I could afford a loan, a $20,000, $25,000 loan on a car, with 1.5%, 2% interest, that was not what I was looking to do, because I looked at the long, 5, 10 year outlook of what I could do if I just pay the car off in full or buy the car, a used car, buy an older car, over 10 years old, keep it in pretty good condition and just not have a car payment. It just expedites how quickly you're able to save and invest is exactly what I wanted to do. The loan types you're gonna be using is if you're low money down, first time buyer, most likely the best options here are FHA is a 3.5% down loan, or conventional, which is 3% down. That's in the ballpark of, like I said, the 7 to 12 I recommend of saving before buying. But if you know that ahead of time, it's not typically 20% down for a first time buyer on a property. It's a lot easier. The requirements are there for these first time buyer programs. So you could look into FHA, which is 3.5% down. You can use it as a rental property loan for a 2 to 4 unit multifamily, which is exactly what I did. Or you could look at 3% conventional. You will be paying PMI or MIP for the life of the loan here. FHA does not fall off. You have to refinance to get out of it, But again, it's basically insurance. In case you're unable to pay the loan, you have to pay it monthly. It doesn't go anywhere towards your principal or anything like that, but it is an expense you have to plan for when you're looking at your monthly mortgage payment. Two that are not as common are VA loans and the USDA loan. Those are both 0% down. USDA is only in rural areas, and VA is a veteran or a spouse. Those are two other options, but they're not quite as common as the 3.5 or 3% down 3.5 or 3% down loans. Tip is know the monthly principal, taxes, insurance. So this number here is essentially your monthly mortgage payment. Once you have your finances in order and you're able to know your debt to income ratio is how much roughly you could afford, you have that pre-approval letter, and you know what loan you're going to use. So if it's FHA or if it's conventional. Next, you need to know your monthly PITI payment. And this number, it could be calculated. There's four main things here. In a $300,000 house, which is the example, the principal and interest, initially on that loan, you're going to be paying heavy amounts towards the interest. And near the end of the loan, typically it's a 30-year fixed loan where the rate stays the same over 30 years. Right now, they're around 3.25. That will be mostly towards the principal near the end of the loan, but when you start the loan, it's going to be very high in the interest payment. That number is going to be your monthly mortgage amount. Your taxes tend to go up, and your insurance tends to go up from when you buy the property every year in a nutshell, but it doesn't go up a ton. But this number here, this PITI number, is your monthly payment. This is important to know, just because if you're looking at property, let's say in the 300 range, your monthly payment does not change a lot if you buy a property at 280 or 290 or 300. That monthly payment is still in the same ballpark. It doesn't change drastically. It may change by $25, $50 in that price point. But this number is really, can I afford that on a monthly basis? And what is that comparatively to if I'm paying rent? You want to look at that figure. If it's a rental property, you want to look at if my monthly payment is, let's say, $2,700 and my rents cover $2,500 of that, or my rents cover $3,000 of that. Am I comfortable with that? And that's something you can kind of dive into and see if the numbers make sense for you on a purchase side. The one beauty about those two loans, especially the FHA, owner-occupied loan, it's considered a primary residence, so you will get a better rate than an investment loan. Right now, they're right around 3%. 3% is the owner-occupied rate. The investment loan is 3/4 of a point higher for an investment property. So the beauty is you can use an FHA loan. You can live in one of the units if it's a 2, 3, or 4 family. You get that owner-occupied rate, and you're going to be able to keep that rate on the loan. Down the road, you could consider refinancing, but again, you probably want to look at the scenario and if your property's appreciated in value or if you forced the equity in your property. But it is a much stronger benefit to start with that owner-occupied rate compared to that investment rate if you are looking at investment property.